All right, let's get into it. So many people are out there looking for that one magic bullet for investing. But here's the secret. There isn't one. The real key is understanding all the different tools you have. And today, we're going to look at them in a whole new way. I love this quote because it just hits the nail on the head. Think about it. Every type of investment, what we call an asset class, is like its own language. It's got its own rules, its own vocabulary, its own way of communicating value. And if you really want to be a great investor, you can't just speak one language. You've got to be multilingual. So that's the big question, right? Which of these financial languages should you actually learn? Well, let's dive into the 5 big ones so you can start building your fluency right now. Okay, first up, we're going to start with the language almost everyone's heard of, the one most people try to learn first. It's the language of growth, and it's spoken through stocks. This is really the main engine for creating wealth over the long haul. So, what exactly is a stock? It's actually pretty simple. When you buy a stock, you're buying a tiny little slice of a company, a fraction of ownership. It doesn't matter if it's a giant like Apple or a small up-and-comer. And the cool part is, when that company does well and grows, the value of your little slice grows right along with it. Now here's the deal. You've got 2 sides to this coin. On the one hand, the upside is massive. Stocks have the highest potential for growth, period. Plus, you might get paid dividends just for holding them. But, and this is a big but, the other side is volatility. The market goes on these wild rides, up and down. That's exactly why you've got to have a long-term mindset. It's absolutely crucial. So who should be speaking this language? Well, it's for the patient investor. It's for anyone who's looking to build serious wealth over years, maybe even decades, and has the stomach to ride out those inevitable market bumps. All right, awesome. So that's the language of growth. Now let's talk about the languages of stability. Our next 2, bonds and real estate, are all about creating a solid foundation and a sense of balance in your portfolio. Let's break them down. First up, bonds. Honestly, the easiest way to get your head around a bond is to think of it as an IOU. You're basically lending money to a government or a big company. And in return for your cash, they promise to pay you regular interest, kind of like a coupon, and then give you your original money back when the loan is due. And this is why bonds are so important. They are the stabilizer in your portfolio. They give you that steady, predictable income, which makes them way less jumpy than stocks. They're like the shock absorbers for when the market gets bumpy. The trade-off, of course, is that you're not going to see the same kind of massive growth in the long run. So this language is for anyone who's really focused on protecting their money, or for someone who needs a consistent, reliable paycheck from their investments. It's all about bringing balance to the force, Okay, on to our second language of stability, real estate. This is all about investing in something you can actually touch, physical property, brick and mortar, as they say. You can do it the old-fashioned way, buy a house and rent it out, or you can do it indirectly through special funds. You'll hear them called REITs, which basically own and manage huge collections of properties for you. And real estate has its own unique flavor. The big plus is you can get rental income, and it tends to be a pretty good shield against inflation. But here's the catch, and it's a big one. Real estate is illiquid. That's a fancy word that just means you can't sell a building in 5 seconds like you can a stock. It takes time. So yeah, the language of real estate is for someone who gets that this is a long game. It's for people who want that tangible asset, that steady income, and are totally cool with their money being tied up for a while. Okay, let's shift gears to our third major language. This one plays a totally different role. This is the language of diversification, and it's spoken through commodities. These things often dance to a completely different beat than stocks and bonds. So, what are commodities? They're the basic raw materials that make the world go round. We're talking tangible stuff like gold, oil, even wheat. And no, you don't have to go out and buy a barrel of crude oil. You can invest through special funds that track their prices for you. Now, the real magic of commodities is that their prices often move completely independently of the stock market. That makes them a fantastic tool for diversification. When stocks are having a bad day, commodities might be having a great one. The major drawback, though, they don't generate any income. A bar of gold just sits there. It doesn't pay you a dividend. So this language isn't really about growth. It's about protection. It's for the investor who wants to add another layer of armor to their portfolio to kind of smooth out the ride with something that just behaves differently. And that brings us to our final language. Or maybe it's better to call it a brand new dialect that's still evolving like crazy. I'm talking about crypto. It's exciting, it's innovative, and boy, is it volatile. So,
Put simply, cryptocurrencies are just digital tokens that live on a decentralized network. The key thing to remember is that unlike dollars or euros, there's no central bank or government controlling them.
And look, the appeal is obvious. The potential for absolutely explosive growth has pulled in millions of people. They're also super easy to buy and sell, like 24/7, and they can be another way to diversify away from the traditional markets. But, and I cannot say this loud enough, the risk is off the charts. The price swings will give you whiplash, the rules and regulations, it's still kind of the Wild West. And you have to go in prepared for the very real possibility of losing everything you put in. So let's be crystal clear about this. Crypto is not the language you use to build your foundation. It's a small, speculative slice of the pie. It's for people who fully understand and are willing to accept the huge risks involved. Okay, wow. We've covered 5 distinct languages, right? The language of growth, of stability, of diversification, and even this new dialect of speculation. So how do we put it all together? How do we build a portfolio that actually says something meaningful? You know, at first, it can feel like a lot to wrap your head around. You're trying to figure out how all these different pieces, the stocks, the bonds, the real estate, are all supposed to fit together. It can all seem a little blurry. And then, all of a sudden, it just clicks. You have that aha moment. You realize, wait a minute, each one of these has a specific job. Okay, so stocks are for my long-term growth. A little crypto might be interesting, but too much is just asking for trouble. It all starts to snap into focus. So let's just boil it all down. The big takeaway here is that there's no single best language. A really strong, resilient portfolio is multilingual. It uses stocks for growth, bonds to keep things stable, real estate for income, commodities for protection, and maybe, just maybe, a tiny sprinkle of crypto for speculation. The perfect blend for you? Well, that depends entirely on your own goals and how much risk you're comfortable with. So, as we wrap this up, I'll leave you with this one thought. You now know the basic grammar of these financial languages. You know the vocabulary. Now it's your turn to start writing your own financial story. So, what's the first sentence of your portfolio going to say?